Hi there, and welcome to this video about the gambler's fallacy and its effect on your trading. As a first step, I will give you a brief background on the influence of trading biases and fallacies on your trading performance. Second, I'll introduce the gambler's fallacy with an example to you. Third, we will discuss how the gambler's fallacy relates and affects your trading. And last, I show you strategies on how to deal with the gambler's fallacy and what you can actively do to stop its destructive influence on your performance. I'm Jonas, co-founder and CEO of Hoc-trade. Let's get started. The human mind is something incredibly powerful, but at the same time prone to a wide range of biases. We can be grateful for this extremely powerful machine up here and cherish it and train it. However, we need to be aware of the tricks our mind is playing with us. This holds true for many areas of life and is especially visible in trading. Common biases can explain a lot of destructive trading behavior. Our mind is simply not wired to be a great trader. Knowing and accepting that you are prone to those biases, as we all are, is the first step to overcome them and use them into our favor in trading. If you accept that you may have those biases and are eager to work on them, congratulations, you just successfully overcame the first, the blind spot bias, which describes the common belief that we are less prone to behavioral biases than the people around us. We will have a dedicated video on the blind spot bias in a few days. At Hoc-trade, we cover many behavioral trading biases through the analytics our AI covers. But today, I would like to discuss one very dangerous one in more detail. The gambler's fallacy, or also called Monte Carlo fallacy. It may be the behavioral bias that created more margin calls than any other. So what is the gambler's fallacy? The gambler's fallacy describes the tendency of humans to think that a random event is more or less likely to happen based on a previous outcome. Sounds a bit theoretical, right? Let me give you an example. Imagine you're sitting at a roulette table, playing black or red. Now there is 10 times red in a row, and a lot of people are starting to bet big bets on black because, well, this must happen now, right? What is the likelihood of 11 times red in a row? Well, the 11th round doesn't care or know whether there was 10 times red beforehand. The new round has exactly the same probabilities as any other round of roulette. Black or red is not any more or less likely to happen. Understood? Okay, so how does the gambler's fallacy relate to your trading? The very same thought process also applies to your trading. Even though you had 10 lost trades in a row, the likelihood that the market gives you a win or loss trade in the 11th is completely unrelated. However, what we see is that traders tend to think there must be a higher likelihood of success now, and therefore increase their position sizes. In a situation like this, two very dangerous trading behaviors come together. One, increase the risk per trade, so increase your position size. Two, emotion-guided trading decisions. Imagine your emotional state after having a loss streak of 10 trades, which is likely dominated by strong feelings of anger, fear, aggression. Everyone creates different emotions, combined with the thought that the next trade is more likely to be profitable. A slightly increased risk with some not 100% thought through trades is likely still a great performance in this moment. However, all-in trades or total capitulation are unfortunately not uncommon in this moment. Now, what can we do as a trader to prevent falling for those biases? The first big step is to actually know about these biases. Know what might happen and how you yourself react in situations like this. The next time you are in a situation like this, you may think back to this video remembering, hey, didn't I listen to something about this? If so, then you're already reviewing your own thought process in this moment. Second, reduce your position size. Why? As a trader, you need to be extremely comfortable with your own trading strategy. You shouldn't start doubting it or feel like there's a higher likelihood of success now after 10 lost trades in a row. How do you achieve this comfort with your strategy? you need to have enough data to back it up. 50 or 100 trades are not sufficient for this. Only once you're comfortable with it, you can achieve this emotions detachment with your trades. So during the process to get there, having enough data, once your position size is so low that you don't really care about the outcome because it doesn't have a significant effect, it is much easier to have this emotional stability during the trade. And the third step is to use a trading tool such as the Hoc-trade AI. The tool constantly analyzes your trading behavior and will send you a real-time alert in case you deviate from your past behavior. In terms of the gambler's fallacy, which might lead you to believe that you should increase your risk, it will send you an alert in case it detects a strong increase from your historic risk level. You're also able to check how you tend to behave after multiple loss trades by checking your dashboard, including this chart, and see whether you actually tend to increase your risk after a few loss trades. If you think that was valuable, please leave us a like and consider subscribing our channel. There are many more behavioral biases in trading with significant effects on your performance. If you would like to try the Hoc-trade tool, please feel welcome to join our Discord server. We are currently in testing and the first access will be given there. I'll put you the link down in the description. I hope you enjoyed this quick snapshot into one of the most common trading biases. Happy trading and stay safe. Please be aware that we at Hoc-trade are no financial advisor. This video is for entertainment purpose only.